Wait, these companies keep getting richer. What about me?
What if you could own a piece of some of the world's biggest companies? What if every time a company grew, made more money, and became more valuable, you could benefit from that growth? That's exactly what the stock market allows people to do. Yet for many beginners, the stock market feels confusing, risky, or even intimidating. Some think it's gambling, others believe it's only for the rich. But the truth is much simpler. In the next 5 minutes, you'll learn what the stock market is, how it works, why stock prices move, and how ordinary people use it to build wealth over time. Let's get started. Level 2. What is the stock market? At its core, the stock market is a marketplace where people buy and sell ownership in companies. That ownership is called a stock or a share. When you buy a share of a company, you're buying a small piece of that business. Imagine a company is worth $1 million. If that company divides itself into 1 million shares, each share represents a tiny portion of ownership. As the company grows and becomes more valuable, the value of those shares can increase. That's the foundation of the stock market. It's not just numbers on a screen, it's ownership in real businesses that sell products, provide services, and generate profits.
If you made it this far, please consider liking the video. It helps me a lot. Thanks.
Level 3. Why do companies sell stocks? Companies need money to grow. They may want to build new factories, hire more employees, develop new products, or expand into new markets. One way to raise that money is by selling shares to investors. In return, investors receive ownership in the business. This creates a win-win situation. The company gets funding. Investors get the opportunity to benefit from the company's future success. Level 4. How do stock prices move? One of the most common questions is, why do stock prices go up and down? The answer is simple: supply and demand. When more people want to buy a stock than sell it, the price rises. When more people want to sell than buy, the price falls. But what influences demand? Things like company profits, economic conditions, new products, interest rates, and investor expectations. For example, if a company reports strong earnings, investors may become excited and buy more shares, pushing the price higher. If results disappoint, investors may sell, causing the price to drop. The market is constantly reacting to information and expectations about the future. Level 5. How do investors make money? There are two main ways investors make money in the stock market. The first is capital appreciation. That's when a stock increases in value. For example, if you buy a stock at $50 and later sell it at $100, you've doubled your money. The second way is through dividends. Some companies share part of their profits with shareholders through regular cash payments. Investors can spend those payments or reinvest them into more shares, allowing their investments to grow even faster. Level 5. The power of compounding. One of the most powerful concepts in investing is compounding. Compounding happens when your investment returns start generating their own returns. Imagine investing $1,000 and earning 10%. You now have $1,100. The next year, you earn returns on the full $1,100 instead of the original $1,000. Over time, this creates a snowball effect. The longer money remains invested, the more powerful compounding becomes. This is why many successful investors focus on time in the market rather than trying to predict short-term movements. Level 6. Investing versus trading. Many people confuse investing with trading. Investing focuses on long-term ownership of quality businesses. Investors often hold stocks for years or even decades. Traders focus on short-term price movements and frequently buy and sell. While both approaches exist, history has shown that long-term investing has been one of the most reliable ways to build wealth. Level 7. What about market crashes? One reason many people avoid investing is fear. Markets sometimes fall. Corrections and crashes are a normal part of investing. But here's something important to remember. Throughout history, markets have experienced recessions, crises, and crashes. Yet, over the long term, they have repeatedly recovered and continued growing. Successful investors understand that short-term declines are part of the journey. Instead of panicking, they stay focused on the long term. Level 8. The importance of diversification. Imagine putting all your money into one company. If that company struggles, your entire investment could suffer. That's why diversification matters. Diversification means spreading your investments across many companies and industries. This helps reduce risk because you're not depending on the success of a single business. Many investors achieve diversification through index funds, which own hundreds of companies in a single investment. Level 9. Can anyone start investing? Absolutely. One of the biggest myths about the stock market is that it's only for wealthy people. Today, many investment platforms allow people to start with very small amounts of money. You don't need thousands of dollars. You don't need to be a financial expert. What matters most is consistency, patience, and a willingness to learn. Thanks for watching, and see you in the next video.